Hi everyone. Uh, Today we are going to talk about financial statement, and our team is conformed by Irán Gómez Camacho, Dana Paula Hernández Juárez, Tami Amaru Telles Miranda, and me, Luis Jesus López Díaz.
I am going to start with introduction. So the financial statements provide small business owners with the basic tools for determine how will their operation perform at all times in their business. And these statements are considered reports designed to summarize financial activities for a specific period. And other important thing is that the forecasts are valuable in this statement for only two reasons: that you can prepare your forecast that assume that the basic financial facts about company will remain you, and the same for a specific period in the future. Next, please. Well, the two key reports for all sizes and categories of a business are the balance sheets and the income statement. These two are very important in this topic. And the first time, the balance sheet is, well, the statements that list the total assets and the total liabilities of a business. And the income statement records the revenue versus expenses for a given period of time.
Okay, I am Dana Paula Hernández Juárez. I'm going to talk about the importance of financial statement. Many business experts and accountants recommend that you prepare financial statements monthly, quarterly at a minimum. Some companies prepare them at least once a week, sometimes daily, to state a rate of results. The more frequently a company prepares their financial statements, the sooner timely decisions can be made. There are 4 types of financial statements, and these are compiled, reviewed, audited, unaudited, and unaudited. The next topic is collecting and managing data, and this talk about that today the Financial Accounting Standards Board, the SEC, and the American Institute of Certified Public Accountants continue to refine and revise concepts and practices. Regardless of how complex a financial statement may seem, it is based on logic and practicality. Collecting information for financial statements begins with the daily arithmetic of business and follows a continuing process called the audit trail. Amounts are balanced and then used to prepare financial statements. In most computerized accounting systems, the balancing is maintained in real time behind the scenes, allowing financial statements to be prepared at any time. And the last topic that I am going to talk about is the income statement. That is the business revenue, expenses, and the resulting profit or loss over a given period of time are detailed in income statements. It is also called the statement of income and expense, a statement of earnings, or the profit and loss statement. This report reflects the company's chosen fiscal year. For tax purposes, the owner may need to prepare a second income statement based on the calendar year. If the fiscal year is different, check with the tax advisor about Internal Revenue Code requirements. The following terms are commonly found on an income statement, and these are heading, column headings, revenue, less sales return and allowances, cost of goods sold, gross profit, operating expenses, total operating income, other revenue and expenses, pre-tax income, extraordinary gain net of income tax, and net income and earning per share.
The next one is the balance sheet. And the balance sheet records the total assets in a business, the liabilities and equity of a business of a specific day, daily. And this statement is divided into provide views of the same business. What resource the business owns and the credit in the other part with the owner investments that supply the resources. And these two divisions are generally used or set up in the two columns. On the left, we have the assets, and on the right, the liabilities or the equity. And the backbone of the balance sheet is the fundamental accounting, the equations. And this equation it's solved and it's based on the accounting principle that every business transaction has, such as selling merchandise. These terms are commonly found on a balance sheet that are heading assets, current assets, long-term investments, fixed assets, other assets, and liabilities. The next ones are current liabilities, long-term liabilities, equity, and total liabilities and equity.
Okay, I'm going to talk about the statements of cash flows. And this statement reconciles the equity shown on the current balance distance. For this post, this statement is appertained to as the statement of retained earnings or a statement of shareholders' equity. And this is for limited liability companies. And it's appertained to as the statement of member equity and their for occupants as the statement of owner's equity. It is records equity at the morning of the account period and detailed addition to or deductions from this quantum made during the period. Additions and deductions generally are net income or loss and the proprietor benefactions are and or deductions. The numbers used to collect this statement are deduced from former and current balance wastes and from the current income statement. Now, the reconciliation of equity or statement of changes in stockholder equity. Okay, there exists four main document or fiscal reporting in the statement of cash flows. This is numerous small business possessors and directors find that the cash flows inflow statement is maybe the most useful of all the fiscal statements for planning purposes. The cash is the lifeblood of the small business. If the business runs out of cash, chances are good that the business is out of business. This is because utmost the small business don't have the capability to adopt plutocrat as fluently as larger business can. The statement can be set constantly, year or daily, and this is a precious tool that summarizes the relationship between the balance distance and the income statement. In fiscal account, a cash inflow statement, also known as a statement of cash flow overflows or finances flow statement, is a physical statement that shows how changes in balance distance accounts and income affects cash and cash equals. And also it breaks the analysis down to operating, investing, and making conditioning. Basically, the cash inflow statement is concerned with the inflow of cash in and cash of the business. The statement captures both current operating results and the coexisting changes in the balance distance. As an analogical tool, the statement of cash overflows is useful in determining the short-term viability of a company. This is particularly its capability to pay bills. And now we have to understand that the quantities and causes of changes in cash balances is the interpreter nor can really budget for continued business operating and growth. For illustration, the statement of cash flows help answer similar question as will present working capital allow the business to acquire new outfit or will baking be necessary. Numerous small business may not be prepared the statement of cash flows, and it's still according to GAAP. It should be said whenever an operation fiscal statement are collected, reviewed, or checked by the CPA. In addition, creditors, investors, new possessors, or mates, and the Internal Revenue Service may be bear the information it provides. So this statement can generally be produced by Udmon's account software operation. And now the notes of financial statements. It is important factor does not fit into the regular categories of a financial statement. Should be included as a note. Also, anything that might affect the financial position of a business must be documented. There exist three major types of notes include the methodology, that is the discussion of the accounting principles used by the company. So for example, the accrual basis of accounting versus the cash basis of accounting. Then we have the contingent liabilities, and these circumstances that have occurred as of the statement date and which represent potential financial obligation must be recorded by the type and estimated amount. So for example, a business owner consigns a bank note if the primary borrower should default, the business owner who consigned will become liable. And finally, the required disclosures. It is necessary that all significant information about the company be described in a disclosure statement. So for example, if the business, the last accounting period, the change must be described.
Now we're going to talk about financial ratios. Financial ratios are a relationship determined from a company's financial information and used for comparison purpose. Usually, these measurements or account balance are found on one of the company's financial statements, balance sheets, income statement, cash flow statement, and or statement of change in owner equity. Ratios measure the relationship between two or more components of financial statements. They are used most effectively when results over several periods are compared. Next, please. Safety radios, and we have here one of the examples. Safety radios. Debt to worth quantifies the relationship between the capital invested by possessors and investors and the finances handed by creditors. The advance the rate, the lesser the threat to current or bond creditor. A lower rate means your company is more financially stable and is presumably in a better position to adopt now and in the future. And this is the formula. Uh, the other radio is time interest earned. Assess the company ability to meet interest payment. It also evaluates the capacity to take on more debt. The higher the radio, the greater the company ability to make its interest payment or perhaps take on more debt. And finally, this is the third one, and is the earning before interest and taxes divided in interest charge. Cash flow to current maturity of long-term debt indicates how well traditional cash flow, that is the net profit plus depreciation, covers the company debt's principal payments due in the next 12 months. It also indicates if the company's cash flow can support additional debts. And this is the formula.
Now I'm going to say the key terms and concepts. The following are brief descriptions or small descriptions, an explanation of these terms and concepts related to financial statements. The first one is the accrual basis of accounting, and the receivables Again, this report lists a customer's name and any months, 13, 16, or more than 19 days will the past due, and the amortizations, it's the gradual reduction of debt by means the equal periodic payments sufficient to meet current interest and liquidate the debt at maturity. The next one is appreciation, any increase from the acquisition of the money or only other report or the price are fixed assets or investment to current price market value. The next one is the cash basis of accounting. This method recognizes the revenue and expenses only when cash payment is actually received or made at the moment. The cash flow, these fall into two categories. Inflows, it's the one, these include revenues from sales by owners, and the other category is the outflows that include cost of sales to owners. The common size is the 100% of one category as the basis for determining the proportion that the other statement items represent. Well, the depreciation is the universal accounting assumption holds that all is fixed in these assets with expectation of land deteriorate. The next is the inventory evaluation. Here is the three widely used methods are average cost, the FIFO, that is first in, first out. The next is LIFO, last in, first out. The leverage is borrowing heavily for financial needs in order to minimize the capital investments and will have a max the return on investment. The liquidate is convert non-cash assets into cash, also to close the business by selling all assets and paying all debts. And finally, we have the other three. The first one is liquidity, the ease which, easily the items can be converted into cash without loss. The negative cash flows is when the business cash receipts that are insufficient to meet ongoing costs and other cash needs. The working capital, that is the difference between total current assets and total current liabilities.
And now we will going to talk about financial statement as a management tool. Financial statement analysis can be applied from two different directions. Vertical analysis is the application of financial statement analysis to one set of financial statements. Here, we look up and down the statements for a sense of strengths and weaknesses. Horizontal analysis look at the financial statements and ratios over time. In horizontal analysis, we look for trends, whether the numbers are increasing or decreasing, whether particular components of the company's financial position are getting better or worse. And as a conclusion, we have collecting, assigning, and understanding financial statement provides business owners one of the most important tools for reducing the considerable trouble involved in starting and growing a business. The comparison of financial rates to sedulity moral is perhaps one of the uses of financial information, as it allows the business owner to compare the performance of his or her business with other like businesses. Carefully record keeping leads to accurate financial statements, thereby reducing the business duty burden. Business owners have the occasion to compare their financial rates with suitability models before applying for loans, thereby giving them the occasion to solve any problem that could lead to the rejection of their business operation, loans operation, or equity sacrifice. Thank you very much for your attention.